The wait is finally over after almost 2 months of silence as of a few hours ago. The Federal Reserve just reduced the rate hike to 25 basis points, signaling that even higher rate increases could soon end. After all, mass layoffs are already putting downward pressure on the employment rate. Wall Street is bracing for the largest downside since 2008. Home buying demand is decreasing, and inflation is falling on weak retail sales. With the Fed now opting for smaller rate hikes, some Fed officials believe the pause could come sooner than expected, with rates eventually being lowered. At the same time, others believe this is only the beginning, with the possibility for severe damage if the Fed doesn't raise interest rates longer than expected. That's why we should talk about exactly what's happening, discuss the Federal Reserve's warnings over the next few months, and cover precisely what you could do, because this could be setting a brand new trajectory that we haven't seen for more than a year. So, before we talk about the Fed's recent rate hike and their warning for the rest of 2023, we got a breakdown of what's currently happening in the market, because there is a lot more than meets the eye. For the last year, the Fed's been on a mission to increase interest rate to the point where inflation begins to slow down. However, the problem is that they need to have a better track record of being accurate. Most people need to realize that the target federal funds rate was initially thought to be 1.9% by the end of 2022. But in April, that was moved to 2.75%. In June, it was moved to 3.5%. In August, it was moved up to 4%. And now, it's 5% with the goal of reaching that point within the next few months. Although the good news is that it is working, for the last 6 months, inflation has been steadily declining from its peak of 9% in June of 2022 to now 6.5%, which is still high, but it is trending downwards. On top of that, companies are beginning to downsize their workforce. And even though this is horrible news for the middle class, this is music to Jerome Powell's ears, because this means wage gains are finally beginning to slow. The general philosophy is that when job growth is firm, employees make more money, and when they make more money, they spend more, which drives prices higher. That's why in 2023, the good news is bad, but the bad news is good. And the more bad news we get, the less likely we are to see higher interest rates, which are good. Speaking of good news, the most recent consumer spending report showed a decline of 0.2% month over month during a time when people historically spend more money than usual. This is giving the Fed even more reason to believe that the economy isn't indeed slowing down. However, you need to know the implications of the stock and housing market values, because the latest data is usually telling in terms of which direction the market is headed. First, let's talk about the housing market. In areas like San Francisco, luxury home sales of about $5 million have already declined by 70 in the last year. All homes are sitting on the market longer than they used to, and total housing inventory again fell under 1 million units, with growth slowing down from the last year's peak. Zillow's report notes that the most significant deterrent for buyers right now is the price. The typical home now costs 62% more per month than it did at the end of 2021. This also means that we saw the most significant month-over-month housing decline since 2011, with buyers and sellers still at a standstill to determine who would give up first. Zillow explains buyers step back from high prices while would-be sellers steer clear of the market, resulting of course in lower inventory overall. But even with fewer homes available, 52.9% of them sold for less than their asking price, similar to what we saw back in July 2020. Now obviously, real estate is local, and every market is going to be different. But if you're curious which market saw the most significant decline, Minneapolis takes first, with Oklahoma City, Phoenix, and Houston coming up close behind. Although other areas like Salt Lake City, Raleigh, Indianapolis, Cleveland, and Nashville have seen a relatively significant increase, so it's yet to be seen how those prices will be impacted throughout the following year. However, the most considerable signal to look for in all of this is what's referred to as the pending home sale index, which is probably one of the best leading indicators to look at in terms of the market's direction. After all, past sales only show us where the market was. That is not what it's currently doing. And once you look at today's housing activity based on current contracts, you'll see that we did see a slight increase of 2.5% in December, coming off the record lows for the month prior. However, this is only the beginning because the other impact of interest rates is also happening in the stock market. Throughout the last week, the stock market increased from the 99 optimism that the Fed would hike rates by 25 basis points and then either pause or continue raising interest rates at a much slower pace than in the past. On top of that, there's also the hope that China's reopening economy will help ease supply chain constraints, drive more demand, and boost international trade. Leading, of course, to people finally posting good screenshots on Wall Street bets. Although others say that even though China might drive excess growth, it can also lead to higher inflation if their need for oil materials and goods increases. The Fed may have to raise interest rates higher for longer than expected. The president of the Swiss-Chinese Chamber of Congress said the Chinese energy and raw material needs would compete with European and global markets. Now, the bad news is that Michael Burry warned us that inflation appeared in spikes in the past. It resolved to fool people and then came back. The chart shows that since the 1940s, inflation never just occurred once and then disappeared. Inflation generally subsides in every circumstances, and people celebrate by spending more money, and then reappears for as long as a decade. It's also worth noting that even the White House analyzed inflation post-World War II, and they determined that in almost every case, inflation took several years to normalize from the peak, and it's never flatlined within just a few months. So even though we might be seeing some good news with the Fed and the rate hikes, it's not over yet. At least on the positive side, the average analyst expects the S&P 500 to end the year above 4,000, ranging from 3,500 to 4,500. And there's a record amount of cash sitting on the sidelines, just waiting to scoop up stocks anytime they decline. However, much of that comes down to the Fed's decision over these last few months. Regarding their most recent decision, a 25 basis point rate hike has been priced into the markets for the last few weeks, and there's no surprise there with inflation slowing down. However, the real question that everyone wants to know is simply when will the rate hike stop? We have yet to get any confirmed direction, and thefts are to be expected. But currently, 80% of traders are pricing in one more 25 basis point rate hike in their March 22nd meeting and then a pause while they wait and see what happens. The chief economist at ING said that US inflation shows price pressures are easing yet in an environment of a strong jobs market. The Federal Reserve will be wary of calling the top in interest rates, especially since there's the concern that if investors think inflation is over, they will spend more money, causing inflation to persist even longer. That's why it is believed that the Federal Reserve will not give us any indication of what will happen too far in advance. But now, a peak federal funds rate of 4.75 to 5% is being priced, and all of that will be determined from the information and data we receive between today and March 22. However, on the positive side, consumer expectations for near-term inflation did fall to the lowest since April of 2021 at 3.9% for the following year, which means the Fed's plan is working. Regarding what we think about everything going on, let's talk about the rising unemployment. At first glance, yes, it is shocking to see how many jobs have been lost over these last few months. But in many of those cases, those companies also hired so many people throughout the last few years that the cut still leaves them with more people than before the pandemic. That's why these companies were forced to increase their headcount when times are good, but scale back on some of that when times are bad. And that means there's still room to cut even more if they need to, or they're going to play it monthly to see what happens. In terms of inflation, employment is mainly recovered to where it was before the pandemic, and wage growth is all but returned to normal, suggesting that it's no longer a driver of higher prices. Although separate from that, we are concerned that after this most recent rate hike, there's not much more optimism to look forward to. We have some excellent earnings coming out, and we have the reopening of China. But there's still the hesitation that the Fed may have to increase interest rates a little bit more due to higher demand. and inevitably, that'll weigh down on the market. In addition, plenty of investors are beginning to use cash as an investment within money market accounts because it's currently paying over 4%, which is relatively risk-free compared to stocks or real estate. So only time is going to tell how that plays out or if stocks have to fall even further to entice those people to buy back in. Overall, it is a move in the right direction, and we could very well be headed toward the end of the rate hike cycle as both England and Canada are expected to scale back over these next few months. Let us know what you think, and we will read your comments. We are curious to see where you're investing and what you think will happen throughout the rest of 2023.